Hey everyone, welcome back to Upside Down Data. Today I want to talk a bit about Bitcoin and what some of our models have been making of its recent price action and where we might expect it to go into this new year. So it's been a little while since I've talked about Bitcoin from the perspective of our different models. In fact, I think it was actually before the FTX collapse was the last time that I talked about this. So I want to go back, dig into the data, talk about what they've been making of Bitcoin's recent price action and where we might realistically expect it to go moving forward. So I want to start off by talking about the momentum bias indicator, or MBI, because I think it's a very data-rich indicator. It can tell us a lot. So as the name suggests, it looks at momentum. So there's momentum bias to the upside, really pulling price up, or bias to the downside, really pulling price down. And there's different phases that you can really identify in the way the MBI will behave. You'll see these bull market behavior where you're just kind of spending all this time up in the green, kind of price ripping up in these parabolic moves. Then you also see this bear market behavior where it's deep in the red, these attempted relief rallies, these attempts to reestablish positive momentum bias that just get rejected back down to the red. And then you get into these transitions, these accumulation zones where you'll see the MBI just kind of oscillating around zero, with more or less volatility, which then ultimately builds into the next kind of big bull cycle. And what we've been seeing more recently has been textbook bear market behavior, right? Coming off the all-time high, we attempted to reestablish positive momentum bias and failed, went deep down to the red, and we've just been in the red ever since. Now, if we're thinking about where we might go next from here, could this possibly be a bottom? Is it possible? Absolutely. It's totally plausible. We don't know yet, right? And I think what we're looking at here is the possibility of a beginning of a transition between a bear market, like what we see here, or like what we see here, where you spend, you have attempts at relief that fail, like this. You then spend a lot of time down the red. You don't even get back up to zero on the next time you try. You can see that over here as well. Definitely happened here. And then you kind of see the lows, and then you start into this accumulation pattern. And so that's what I'd like to see. For me to start getting confident that the bottom is in and that we're starting this kind of accumulation phase, I'd like to see us start oscillating around zero, this type of behavior here. Now you'll notice that I'm kind of pointing over towards the 2015, 2016 kind of bear accumulation zone here more than 2018, 2019. And you might say, okay, what's the deal with that? Well, personally, I think that this is probably the more likely scenario, between the two of what we'd see in this bear market going forward. And the big reason for that is the FTX collapse. There's a lot of damage that crypto has suffered in its reputation with a broader public, with institutions, etc. FTX was such a massive fraud that I think we're just going to need time for those wounds to heal. That I think it's just very unrealistic to think that crypto will have meaningful upside, meaningful FOMO and all that stuff, while the memory is still fresh in people's mind of the FTX collapse. That has made a lot of people who are not having been paying attention to the space just think it's all a big fraud, it's all a big scam. And so that's where I think we're probably going to see at best a long drawn out accumulation zone going out from here, that if the bottom ends up being in here, that we're probably just going to get a lot of boring price action for a while coming out of this before we can start moving to the upside. Again, we just need time to heal. That's always my opinion, that's my perspective. Now that could age terribly and things could go differently, but that's my base case, is that if the bottom is in with the FTX collapse, the best we can hope for is something like this. And what I'd be looking for then to start thinking that this is what is playing out is this type of behavior, this oscillation around zero, where we're able to get back above zero, even if it's not for a super long time, start this oscillation. We haven't seen that yet. That's something we want to look for going forward. So I think what this is telling us is that it's very possible that we're in late stage bear market territory, like over here. And then what we'd like to see is this type of behavior to confirm that we might be entering into a new phase in the market cycle. And of course, the big monkey wrench that could get thrown into all of the works here is if we see a recession and if risk assets completely blow up, like the stock market, for example, has a massive crash. That could really throw this off, and of course then that means that we could have further downside for Bitcoin. But if that doesn't happen, this kind of behavior might tell me we're entering into this type of a phase. It's the main point I wanted to mention there. So another indicator that we can look at is our market direction classifier, or MDC. This is a trend indicator. If you're above the critical level, which is this yellow line, that's generally bullish, and price oftentimes will be in an uptrend. You'll see these big explosive moves to the upside when you see that. But when you're in the red, when you're below that level, that's bearish. That means that you're in a bear market or you're in a downtrend, more likely than not. And can be some pretty nasty downside that follows when you lose the critical level. And so more recently, you can see that it's been doing quite well as well, right? It identified this as being a new downtrend quite soon after the highs back here in November of 21. It then was bearish. It was red for the majority of the downside coming into this bear market with just a few relief rallies that popped their heads back up above that level. And now we've just been down in the red really kind of ever since. Now we can look at the critical level, we can pull that up, and it's currently looking at slightly over 18K as being the level that if Bitcoin could rally up past that, it would then flip bullish and think that that it's possible that Bitcoin's entering into a new uptrend, even if that's not that long, right? Even if that's just a brief relief rally, or just kind of volatility in a bigger accumulation zone, it would at least give a suggestion of strength. And if we are going to be entering into a new accumulation zone, I think it's very reasonable that we might flip above the MDC for some brief upside, then come back down for some downside up. That's kind of how accumulation zones tend to happen. You'll get these spurts of volatility that, can be good for a shorter swing trade, but ultimately aren't the real thing until you kind of get out of that sideways chop, really break above that range. Then when you start clearing above the MDC critical level, that can lead to this massive upside that we've seen in the past. Something to be looking out for. I'm certainly going to be watching the MDC and see, can Bitcoin get above it? Because again, that might just be one more sign of strength that maybe we are entering into some kind of accumulation zone. Now, the final thing I want to talk about here is the upside downside potential indicator, or UDPI. So this is the long-term version because it moves that play out over months to multiple months. And if you've been watching the channel, you know this indicator. Red, higher levels of the UDPI mean high risk. That tends to happen at these big market cycle high points, and then oftentimes downside will follow. And then when you get down to the deep green, that tends to happen down in the depths of bear markets. And if we just look at the raw levels, we can see how this is all played out over time. We see a bit more clearly. White line here is the UDPI level across time. Yellow is the Bitcoin price. And so what you can see is that, you shoot off to these super high risk zones, these high levels of the UDPI around market cycle peaks. And then these really deep levels at the depths of bear markets that happen, at around the lows going into accumulation, generally speaking. And so you'll see is that the UDPI level is at, roughly similar levels that we've seen in the depths of other bear markets, which is another thing that might point to this being a later stage bear market point right now, that we might be getting near the end, even if it's not the absolute end, the actual bottom isn't in yet, we're at least close, that the worst of the pain seems like it very realistically could be behind us, given what we're seeing on the UDPI. And again, barring a massive meltdown in risk assets, I think that's a very reasonable perspective to have here. So not financial advice. You should, of course, make of these data as you will. And of course, your broader thesis on the macro environment is going to shape how you interpret these data. So if you think a massive crash of the stock market is coming, then you'd probably expect Bitcoin to go a heck of a lot lower than 16K. You might be targeting 12K, if not even lower, 6K, for example, depending on how bad you expect things to get in broader markets. But if not, if you think that if that's the worst is probably not going to befall broader markets and that historical trends are going to kind of continue into the future, this is certainly looking like a reasonable accumulation zone, like it has back in these prior points as well. Certainly more realistic, way more realistic upside potential on a longer term perspective than downside, but of course not ignoring the downside. Something we have to keep in mind. Bear markets can go longer and deeper than anyone expects, so something you always have to keep in mind. So we can also look at the short-term UDPI, which cares about moves that play over days to weeks, so much more short-term in its perspective, but it's reactive to moves that play out over those shorter periods, and so that's what you'll see. And so what often will happen with the short-term UDPI is it'll kind of find ranges between different kind of zones and spend time bouncing around them, where you'll find resistance at similar levels, support at similar levels. And where we are right now is reminiscent of this period back here in 2015, going into 2016, where we're kind of treating this general range of more or less kind of -4, a bit below that, going up to about -2, occasionally up here to about -1, kind of bouncing around those levels. And so because again, my base case is that, at best what we're going to see here is some sideways accumulation. What I'm personally going to be looking for in the short-term UDPI is, this general level down here probably acting as support, and then this general zone up here probably acting as resistance. And so really, even though we're in a general space where there is a lot of short-term upside potential that could happen, I don't think it will. I think we're generally speaking going to be bouncing around these levels, really kind of acting like, again, late stage bear market going into potential, accumulation going through here. And so really kind of my takeaway from all of these is that I think the data are pointing to a very real possibility of the worst being behind us, and that if we're not at the bottom being near. I'm not going to be, I've talked before about how dangerous it is to call the bottom. I'm not going to do that here. I'm not going to call the bottom. I think a few further lows are certainly possible from here. But I do think that the worst is very plausibly behind us. And really the thing that I would be looking for is kind of that straw to break the camel's back. The thing to change that perspective would be if broader markets just end up falling off a cliff. If we see massive deterioration, a big recession that leads to a massive sell-off in the stock market, I think crypto, as bad as it's already gotten, would get caught up in that and go lower. But if that doesn't happen, then I think the possibility of this turning into an accumulation zone is very real. So, going forward, what that might mean then is that in some ways, crypto, is something that might not require all that much constant attention to some degree. It might just be fairly easy. If we do get that case where we get kind of sideways accumulation, then really, what you do there is you just DCA into the market. That's generally speaking what people have done. You DCA in, and then you just wait until things start going up, and you DCA out. And if we get that kind of period again, in some ways it just means that people are probably going to get bored. You're going to see crypto, people aren't going to talk about it much because they're like, oh, that thing, it's not doing anything. That might just be another indication of that accumulation, right? It's when most people are bored, when most people have left, that end up oftentimes being the best buying opportunities. So again, not financial advice. You should navigate this as you see best fit of what you think should be done. Because again, your macro thesis is really going to shape whether or not you think this looks like a good accumulation zone or not. But I do think that there's a very reasonable possibility that in a year or two from now we're going to look back and say, oh yeah, that was obviously the beginning of an accumulation zone, and that 2013 might just be a lot of sideways chop for crypto, which isn't all that exciting in the short term, but of course the long term would be very exciting. And that's actually the ironic thing about crypto, is that oftentimes when it's the most boring is actually the time when being the most exciting, at least historically speaking, has paid off the best. All right, if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. A lot of updates, better indicators, and more over there.